All right. Good morning. It gives me an immense pleasure to welcome you all. One of the most interesting debates happening in Asia Financial is definitely around HDFC Bank. So thanks for taking the time out over the course of this day. My colleagues and I have put together a series of meetings with the top brass of HDFC Bank within the bank and as well as the group companies, the CXOs of which are present to meet you over the course of this day. My name is Rahul Jain. I head research at Goldman Sachs in India, and I also write research on banks and financial services. Now, without much ado, let me start our first session with Sashi. Sashi, thank you so much for your time. Without, maybe just to start off the session, would be great to hear your thoughts around the macro and particularly the situation around liquidity.
I mean, you and the people in the room are far more greater experts on macro, but having said that, what I feel from our vantage point is that India is in a very sweet spot as regards anyone else globally at this juncture. I guess post the verdict in the next elections, which is around the corner in May, we have a belief that it's going to be even better. I guess within that, you will have the checks and balances of fiscal responses and monetary responses, but that's normal in any business cycle and in any kind of to ensure that it's on track. But more than that, in the mid to long term, what I see India and where we are, we travel a lot and we have our distribution across the entire length and breadth of the country. So we do have a lot of customers across the country, and therefore the pulse at the ground level seems to be absolutely far greater than what we have ever seen in terms of energy levels, in terms of per capita levels. So we are reasonably sanguine that India is on its way. We have already demonstrated that we are a global services hub. I think it's just a matter of time over the next 10, 15, 20 years that we should be not just a global consumption hub, but also a global production hub as well. Optically, you may not see this happening now, but underneath, there is fair amount of activity that is happening. Hopefully, in the next 4 or 5 years, with a new government in place, and there is a strong probability of the current regime coming back, and the policies being continued, probably you will have a step up in terms of the economic activity. So whilst that's just a kind of an expectation, I'm not sort of relying necessarily only on that. Still, we as a bank have continued to grow reasonably healthily in multiple business cycles, and we believe we have that kind of a strength in our distribution franchise to continue to do so.
Thank you, Sashi. Very bullish outlook, if I may say so.
I'm an India bull.
Thanks. Just switching gears a bit, when we talk about the GDP growth, no questions, I think India is one of the fastest growing economy. But the challenge historically has always been around the funding of the growth that comes through. And for the banking system, the most relevant data point that we track is, of course, deposit growth. Inflation has been by and large under control, but yet RBI has been tightening liquidity. So how do you see that scenario emerge? And we saw in the previous quarter, the deposit mobilization for the banking system started facing some headwinds. So how are these different trends are evolving according to you, and how do you as a CEO of the largest private sector bank planning to control?
So I think the franchise has been, if you look at a long-term trend of how we have been growing the funding profile of the institution, it's been reasonably healthy. When you look at it, we have been gaining market share in deposits for not just now, but whether you take a 10-year horizon or a 5-year horizon or a 3 or a 2, even a last year as well. we've been adding roughly about 50 to 60 basis points of incremental share per annum. And which means that it translates to anywhere in the range of 15 to 20%, depending on which quarter it is, which is much higher than our stock of share that we have on deposits. That's about 10 to 11%. So obviously, we have, it sort of speaks volumes about how the distribution is well poised in terms of its focus, granular focus, and the ability to raise the bar with every passing year. And therefore, you have seen largely, even if you strip off some of the things that we have acquired on the merger, I think a reasonable amount of 18 to 20% growth is what we have seen for a long period of time. Now, there will be times when, because of certain monetary policy actions, you will see the liquidity in the system getting tighter, getting negative deficit. The October to December was one such event. We probably would have seen it somewhere in the 2019, and then prior to that in 2012, 13. I guess I'm not able to recall that, but these are rare instances which the monetary policy teams normally take into account. Obviously, inflation is one such metric which, rightfully so, they are very paranoid about to control, and these are things that is necessary to as a part of larger action. During these periods of time, there will be scrambling for funding. Rates, yields, the short-term yield curve will move up. Some of the deposit rates will also move up, especially for the larger ticket sizes, etc. And that's exactly what happened. Now, whether it's wrong or right, we collectively took a call not to participate in some of the high-cost incremental flows. So, which means that not only did we not participate, we had to give up some of the ones which came, which were there, came up for maturities. And yes, that would mean that it'll be way below the expectations. But as they say, one swallow does not make a summer. Well, it was said on the positive aspect of it. I'm saying on the reverse as well. So it doesn't mean that we will, we have a problem. I mean, when you say when you take the long-term average, we have continued to meet our expectations. This is something that we took a call, and maybe even if it will continue for a couple of quarters, we are all right. We are sanguine about it, but we still feel that our earnings trajectory should not be impacted. And I'll explain that as you ask more questions around that.
Sure. I think it's an important topic. So just to double click on this, now clearly the RBI has clearly mentioned that inflation is the primary focus. We don't know which way the monetary policies goes. Irrespective of that, how do you feel about the deposit mobilization for the bank over the course of next few quarters?
See, over the last 7 quarters, the last quarter being the 7th one, so if you take the 6 quarters, ever since we announced the merger, we realized that with the merger will come a preponement of loans in our balance sheet, which is pretty much reflected in the constitution of the share. I mean, we now have around 14 to 15% share of loans on the stock of our balance sheet, as against to 10 to 11% of deposits. Obviously,
market share.
In market share.
Yeah.
So obviously, what they did not have too much of deposits. It was more wholesale or the bond funded, rightfully so, because it was a long-term book, and they wanted to have a very matched duration. So they sort of managed it pretty well. Now that is completely new to us. obviously there is something which is now come in. We realize that effectively we have preponed the loan growth, so I need to now have that period of I would say, what do you call it, transition time to warm up the engine to raise that amount of equivalent granular sustainable funding to be able to substitute some of the bond maturities so that I can have a reasonable amount of share moving up and so that matching with that of the loan market share. Obviously, it's not going to happen overnight. It's a kind of a glide path that we will be seeing. In the meantime, obviously, whatever I raise, if I raise a lot more, then I'll have enough to maintain reserves. I'll have enough to pay off the bond maturities or the loan maturities that will come up there, and the balance we'll deploy it. If I have constraints because of the monetary policies or monetary situation, liquidity situation in the system being rather tight, to that extent it will be much lower. But yet, just by repayment of the high cost borrowings, you will see the trajectory of profitable growth continuing. So this is the period of transition we will have to adjust to. And so our anchor is that as a company for 29 years, we have always been consistent on the bottom line growth, which you can call it the earnings per share or whatever that is. And going forward too, we will have that as an anchor. So a lot of other metrics you may want to sort of ignore because of the transition, especially on the loan growth, and that could be a tad lower, but that's all right. I mean, that is something that is not going to be at the cost of my earnings trajectory.
So 2 points I took away from your statement. One is you have reasonable degree of control over deposits.
Absolutely.
Second
sustainable, granular sustainable deposits. If you really look at it for a long period of time, our granular retail, what we call retail, whether is about around the 80+% of our total funding. You will also appreciate that we are we are market leaders both in the corporate segment and the SME segment as well. And therefore, from a customer relationship perspective, we need to have a certain thought process to patronize that relationship. So some amount of bulk deposits will be there, but it will be within the range that we've always operated on. In future, for whatever reason, you do have an opportunity to have even some of the large ticket at a cost which is much lower. Why not? We'll patronize that. But as of now, the entire franchise, the distribution franchise, we are asking them to focus and don't get sort of clouded by what's happening in the market in terms of rates. Just be focused on customer engagement and service first culture. That's my biggest priority, and that you will see and hear it more when you start talking to our heads of branch banking during the course of the day.
Sure. The second point which I took away was the loan to deposit ratio.
Yeah.
We had a lot of discussion on your last earnings call also, wherein I think Srini mentioned about loan growth versus deposit growth. You also articulated that the LDR is the focus. How should we think about the glide path of the LDRs? And let me also add to that, there were some murmurs about RBI opining on the LDR ratios for some of these specific banks. Have we heard anything from the RBI, or how do you view the evolving trends in the system?
See, the LDR is a kind of one of our important aspects of any bank's asset liability committee, and so the management. Okay, if you remove the merger, we have been operating our loan deposit ratio in a reasonably healthy range of around 85 to 90% or 80 to 90% depending on which year it is, and it's a long-term average. Obviously, we have grown, which means that the growth rate in our deposits and loans have been rather on very similar pace of growth. Therefore, you could maintain that kind of a LDR. Obviously, with the merger, which I'm sure even the regulator would recognize, that there's something, a foreign body which has come in with a certain amount of a metrics or a mix, business mix. So what we have inherited is something that is we have to accept. Now, incrementally, what I do from here on, leave aside what we did in quarter 2 and quarter 3, leave that is already baked in. Now, going forward, whatever we do will be very similar to what we have done in the past, which means that we'll maintain a very healthy incremental LDRs. As I said, it's a balance of how much I want to deploy and how much I want to repay, and that itself, since these are all high costs, it sort of gives you a kind of a massive fillip to your profitability. So that will definitely be one of the most important deployment strategy. And therefore, intuitively speaking, the moment you do that, your ICDR or incremental deposit LDRs will be far more healthier, which means that even the stock that we have will also sort of go down much faster than what we probably would have envisaged in the past. I'm not giving any timeline, but I can visualize that if we had taken a longer time period to have done that, this would be probably slightly faster.
Understood. Very interesting.
And the reverse of LDR, I'm just preempting a question, the reverse of LDR is the LCR. So effectively, when you have this kind of a strategy, automatically your LCRs will be in a very healthy band. We've always operated between 110 to 120%. Somewhere in between is where, between the 110 to 120 is where we've always operated, around the mid of that. And I think that's a very respectable and a very healthy level for a size of our bank, which provides you adequate cushion in terms of any emergent needs.
Very appropriate. So just again, a small follow on. I think the investors think about the stock level of LDRs, but there is an element of the fixed tenure borrowings which cannot be taken care of. How are you monitoring that number? Is it the incremental number that is more relevant to you and your management team, or the stock number?
No, the stock, you and I can't do anything about it, because the bonds, large part of the funding which is in bonds are non-callable in nature. So I have to wait for the maturities to happen. But whatever maturities we know that is likely to happen over the next every year is good enough for us to have an impact on our profitability. But so effectively, what we put will be after that. I mean, whatever I raise, I maintain reserves, I maintain, part of it repayment, and the part of it is borrowing. So when you have a certain incremental loan deposit ratio that will emanate out of this strategy, automatically your stock of LDR will also have a downward glide path. So as I mentioned, we are not too worried about it. If the system becomes as benign as how it was at the time of the announcement of the merger, then maybe I may not need to even pare down some of the loan growth. I will have that enough to even grow that, etc. But I'm not even expecting that. I don't want to even have that kind of an expectation that we will go back to a certain amount of extremely benign liquidity situation in the country. I'm expecting that, as I said, the caveats are that I need to ensure we will have a similar kind of liquidity situation now. It may become slightly better. I'm sure it's already getting better. But we're not sort of, trying to take some scenarios where it will be more benign. I'm just saying, take the worst case scenario that we will focus on granular deposit mobilization. Whatever we have out of that, we will, and that's a number which I think we are reasonably comfortable. And as I said, don't go by what came out in the third quarter. That doesn't mean that that's the indicator for the future. As I said, for all of you to believe, be patient, wait for how we mobilize in this quarter and the subsequent quarters. That will sort of demonstrate the kind of intensity we would have in a transition period. And as I said, we're rather sanguine about our trajectory. I think I know, and with a lot of humility, I also sort of taken a lot of feedback from all of y'all in terms of what went wrong and what are the things that we should do right. I mean, as I said, without spelling that out, I think we will try and be focused and get our continue our what we were well known for in terms of profitable growth.
Sure. You made one interesting point about the loan growth, and it's an important point because clearly you talked about liquidity also. But loan growth has multiple elements to it. There's retail, there is commercial rural banking, there is wholesale, which also has now the erstwhile HDFC Limited's portfolios. When you think about slowing down to adjust the incremental LDRs, which segments you think bank will not compromise on, or the franchise business, so to speak, or they'll be all across rationalization as you think about?
Yeah, see, it's not easy. You can't do pick and choose, sure, and you can't artificially hold back certain segments not to grow, etc. I mean, that's not the way we manage our businesses. Each of our businesses, whether it's a corporate banking, whether it is MSME banking, whether it's retail banking, whether it's mortgages, is extremely important strategically. Okay, a corporate banking is completely on relationship base, and with corporate banking, there is an integrated business coming out of the MSME banking, because the supply chain of the corporate is where you get more access to the MSME part of it. With the corporate also comes in with the corporate salary, which is one of the largest portion of our consumer banking itself. So this is integrated. I mean, I cannot say that I'm not going to be patronizing a corporate relationship because, well, the yields are low. No. I mean, if you see that, that's a very parochial way of looking at things. Yeah. So it's important that we have a balanced approach. Yes, it's not going to be easy, but there will be a balanced approach. And as I said, if you look at the long-term trajectory, I mean, I know you look at it over the last 20 years, we have been maintaining a 1.8 to 2% ROAs, not because of the fact that I'm focusing on unsecured or focusing on retail. Yes, it was 55%, 45%, but even when COVID happened, when the mix changed, the margins may have come down, but the ROAs were maintained because all these are integrated. So we will continue to do so. Yes, the reason why you may have a tad lower than what in the recent past is just the weight of the extra borrowing that has come in from the merger, and that is something that it's a period of transition before that sort of becomes smaller and smaller, and that will be visible as we execute during this period of transition, as we substitute borrowings with deposits or slow down over a period of time.
Thank you, Shashi. Just switching gears a bit more on the profitability on the loan book, or let's say margins and the cost of funds. RBI governor has on multiple occasions talked about that the transmission is not adequate in the banking system. We've seen in the month of December, State Bank of India raised the term deposit rates. So clearly the cost of funds seems to be taking a U-turn. And in that state, how do we manage the margins? Because like we have to scout for deposits, there is a pressure on cost of funds, and then there's the margins that we think about as a natural corollary to this. So how are you balancing both the equations?
So leave aside whatever we have inherited.
Sure.
Okay. The fact of the matter is that minus of the foreign body that has come in, which is the book from HDFC Limited, there was a certain band at which we were operating in. I think somewhere between 4 and 4.4 for a long period of time. If you look at it, minus of that, we continue to maintain similar kind of a thought process. Why? Because we know in periods of tight liquidity, in periods where the funding is scarce, the rates will move up. So we have the right balance of what we need to do in terms of risk-based pricing, and this is not something new. We've been doing it for a long period of time, and I'm sure Srini would have done it in his earnings call as to how many we let go as well. For the risk appetite that we are comfortable, I think the pricing is more or less right. Okay, so yes, it's going to be tight. We are constantly, the only element, assuming my expected, the risk appetite continues to be the same, or the expected credit loss is the same, the only thing that is changing in the risk-based pricing model is the cost of funds. So to that extent, you will see constantly our asset liability committee management constantly raising the threshold level so that we don't sort of go down the margin ladder. Incrementally, I think we are reasonably sanguine that we should manage that. As I said, we are not in the quantity game at all. We don't want to grow just for the sake of market share. Very clear, this is not a new philosophy. This is a philosophy that we have been building our franchise over the last 30 years, and we are proud of that. And we have also mentioned, and you have seen it in the past, that any exuberance in pricing, any exuberance in I would call it the hardball based pricing strategies is all short term in nature. I think we are a long play, and therefore we are happy to wait till these corrections can happen. But we are not going to be compromising both on margins and risk. So there is a certain trajectory that we will operate, a band that we will operate, whether it's a margin band, whether it's a ROA band, and that is something that we are very particular. If there is some kind of a disruption there, happy to go slow.
Understood. And even if that means certain pockets continue to face pricing onslaught from either the SOEs because the balance sheets are healthy all across.
Absolutely.
Or mortgages.
Absolutely. We have demonstrated several times in our 30-year history, whether in the early 2000s when a certain product, retail product pricing was not appropriate to the risk that was inherent in that particular product, or during the infrastructure cycle boom where the risk was not well priced in, or was not something that we wanted to pick up, or even now. I mean, during the tight liquidity situation where there was been scampering for deposits, we said that it doesn't make economic sense. Some portion we are happy to patronize for the relationship basis, but otherwise not necessarily to a large extent. So we are happy to give up some amount of growth, but going forward you will see that very clearly the profitable growth is what we will. There is. It's not that it's the entire system has gone topsy-turvy. It's just the pockets which we don't want to operate.
Makes sense. Very clear. Thank you. Just switching gears, coming to the strategy around the investments, capacity build up, including branches, as well as the non-branch element of hiring employees. How do you think about that? Of course, I have to bring back third quarter. There was enough confusion versus the earlier guidance that we had talked about of 1,000 to 1,500 to 2,000 branches. How do you view the current environment in that context for the investment that we have been doing?
See, as a CEO, as the helm of the institution, I have a certain vision. Okay. In all humility, I must say that going forward, I'll caveat my vision to say that it's a vision and not a guidance. I don't think I need to blame anybody in my team to have given a wrong narrative on that particular front. Yes, what I wanted to convey is distribution is extremely important for a very granular and sustainable funding into the future. And I maintain that. But whatever we are investing is not for now,
Sure.
it is for the future. You look at the trajectory, and I'm sure our team has put it up in the domain, that there is a life cycle of a branch.
Yeah.
In the first 5 years, this is basis our actual experience. In the first 5 years, if there are 100 units which get mobilized as deposits, in the 5 to 10, it's about 3 times that, 300 units. In greater than 10 to 15, it's about 10 times that. And beyond 15, it's 25 times that. So that's a geometric progression of how the productivity or a deposit per branch, if that's the metric that one were to look at, has a trajectory. Now, obviously, when you look at the actual experience, it's very clear that it starts to move the needle 8 to 10 years from now. I can be, frankly, if I was a very more worried about now on the shorter end, then we would not have. We said, forget it. Let my future successor talk it. Worry about it. Why should I worry about it? But that's too parochial. That's not strategic.
Yeah.
So I still maintain that branch distribution is going to be an extremely important part of a strategy. Otherwise, you will miss out opportunities into the future. So that's part one. Part two is, along with branches, you will need people, because even in a very digital world, the branch distribution is going to be more an engagement center. Your acquisitions will be digital, your transactions will be entirely digital. So why would I need a distribution? That's because there I need people to be engaged, to engage with customers. Finally, the only differentiation that will remain in future is how well are we able to engage and get that emotional quotient in. Primary banking is going to be basis that kind of an emotional quotient that you establish with customers. It's not a digital platform, sadly, is very good from an efficiency perspective, and I'll talk about that, is extremely important even as a part of our strategy. But it's going to be extremely cold and impersonal. And banking is not like buying anything on a platform. Sure. Yes, you can buy, but ultimately, if you need, what is the key element in a bank's valuation is its annuity of flows, and that will happen only if I engage, and that personal and the human touch is extremely important. So branches are going to be extremely important. People are going to be extremely important. But the fact that we're going to have a rather seamless experience, and that's what we are investing rather heavily, I think you should see the operating leverage kicking in. And you will start to see that. I mean, we've opened a lot of branches over the last 3 years. Srini probably in his one-on-ones will give you that most of the branches are all on track in terms of breaking even, which means that when they all break even, you suddenly will see the jaws opening for the new set of branches as well. So it takes time. We need a little bit of patience, but you'll see it.
Sure.
We have demonstrated from over the last 10 years from a 49% cost to earnings to a 41%. And you will see this happening even now. I'm not going to give any guidance where you're going to be, but just following a similar trajectory, you will see the operating leverage kicking in.
So two follow-ons. One is the investment in branches goes on irrespective of what's happening to the NIMs. That we need these branches for 3, 5, 7 years later.
Yeah.
So that point is well established. The second is on the operating efficiency, the synergies of the new merger that we have, of the merger that we have done, plus the branches that you've opened. When should the investors start thinking about those? Will it take some more time, or are we almost there because we opened the branches 3 years back? How should we think about it?
See, all that we have been opening or we have opened will start on its own. When you see the waterfall, it's already starting to open up. Okay. But since you're continuing to add more investments in the future, maybe you will not be able to see it. But at a certain scale, I think over a period of time, a combination of the NIM expansion arising of the repayment of borrowings and the fact that the operating leverage on itself will start to open up. I think in 2 to 3 year period, you will start to see it will become rather visible.
Okay.
So, as I
on
said,
the stock basis.
on a stock basis.
Yeah.
So, I'm pretty much sanguine that despite the kind of investments that we'll put in technology, despite on the distribution side, you will start to see the cost to revenue trajectory going down.
Sure. I'll slip in this question on digital also because that's close to your heart, and you've really taken it up big time in the last couple of years. How's the progress on the digital properties that you were supposed to launch? A few have been launched, a few have been in the pipeline. What's happening to those? How's been the impact of those on the customer engagement and the business throughput that you're getting?
So there are 3 parts that we are focusing on over the last 3-4 years. One is to get our core underlying architecture far more, I would say, scalable, secure, and resilient, so that we are not sort of see in any technology, if anyone says that you can have zero downtime, it's a utopian thing.
Yeah.
But you will still have a lot of threats, vulnerabilities, because there is an outside world which is far smarter than all of us put together in the globe. And they seem to be running like a business model. Or you will have machines obviously have also a fatigue factor which will happen, so downtimes and threats will always be there. The key is, how is our response going to be? How is our reaction going to be? I mean, are we geared to have a quick response so that the inconveniences are much lesser from a customer perspective, and the defense mechanisms are rather secure to be able to thwart these vulnerabilities? Sure. That is the first priority that we have been focusing on. Are we 100% there? No ways. And that's another myth I want to sort of clarify. No entity in the world can ever say that they're 100%. That is not possible, and that is not something that anyone should accept that. So, but there is a glide path to ensure that a large part of it is there, and we constantly invest to ensure that we are ahead of the curve. The other one is the middle layer, which is where you expose all the APIs onto the middle layer, and then that can be exposed to the world at large. So you probably would have heard about the word factory that we had set up, and that factory continues to do so. And then there will be a time when we would move a lot more of these on a reusable basis to be not only exposed within our other satellite systems, but also to the world at large. And that is the reason why we set up a banking as a service as a unit to sort of unleash these kind of opportunities that will be there when we complete the middle layer exposures. The top layer is where the customers see, and that is the experience that people normally compare with, rightfully so. Where we did sort of invest a lot in the past, but unfortunately there were a lot of other events that happened over a period of 2018 and 19 and 20, which is well chronicled now. And therefore, we now have been silently working on that to repair and sort of come back on that particular front. So consumers will start to see that slowly but surely. We already launched for the merchants. We have launched on the payment side through the Paze app without too much of fanfare, but we already see the adoption going up. Mobile banking, though, is rather dated, has seen, with a lot of re-engineering, has seen a good amount of progress, but the new ones will be launched during the course of the year. Slightly delayed because we realize that there are a lot of other priorities that we need to do so much as. So that's similarly, we have our a lot of front-end platforms for the MSME sector and also the corporate banking. All the wheels are in motion on the frontline side, and I think we are silently trying to ensure that our customers migrate onto our new platforms. I think there will be a point in time wherein we will have a separate session only on that aspect, but the philosophy that we are going with inside internally now is launch, have a fair amount of adoption, let people like it, and then showcase.
Makes sense.
Yeah.
I wanted to bring up the latest, or rather the topical point within fintech is Paytm. You have partnership with Paytm as well. Can you just talk about how you're seeing the relationship play out, and does RBI action on them with regards to the payments bank open up huge opportunities for the banking system with regards to just the broader topic of fintech versus the traditional banks, the private banks? Can you now take away more market share within the UPI ecosystem?
Look, whatever has happened on that particular entity is rather unfortunate. So obviously there is certain little bit of an unknown. I know nothing more than what you would or anyone else in this room knows. So having said that, I think they do have a great tech platform, and that is what we have a partnership which sort of harnesses that. And it's not a big thing. As I said, these are experiments that we are happy to sort of continue as long as we maintain control of the regulatory norms, etc. Now, does it open up a lot more opportunity? If you really look at it, I think we are far more sanguine on what we want to acquire, even on the merchant side. Let's talk about where all they were very good. The FASTag is something that they had a reasonable amount of market share. Now, obviously, that may get distributed amongst a lot of other people. Yes, there may be some amount of shares that will be low. Then you have Paytm app was a very good app, very well respected. A lot of active users on that. I guess we have a Pays app which probably can get a slightly better run rate, and that's what we hope to have. On the merchant acquiring, I think they were also one of the large players there. We probably may deal with a certain segment which is quite an attractive opportunity. I don't want the entire thing. Because we are focused on a certain segment which makes economic sense. So we are sort of finding these pockets of opportunities to do so. I think these are some of the things that is there. I think the franchise is ready to take on anything that comes their way, which makes economic sense. We're not targeting that. We are not in a hurry to say, I want that much, or I want the entire thing. I mean, that's not how we operate. As I said, the underlying thought process is it has to make economic sense for whatever we assume. So we are on that track organically, I guess. At this juncture, we are in the market trying to pick up the ones which are available, and that's what we're trying to do.
Sashi, we have 50 minutes past and it's been a very engaging session, but two important areas I want to talk about with you. One is on the credit quality. There are 2-3 aspects of it. Unsecured book, where RBI has also talked about that people need to slow down. There has been an irrational exuberance. You have already slowed down. You have not really grown much. How do you see or think about the credit quality, and is there any method behind why you did not choose to grow in this portfolio?
I mean, that's the USP. Our credit architecture is what we are quite famous for, and we are proud of that architecture. And I guess whether you like it or not, that architecture sort of has a sixth sense which sort of knows when to grow and when not to grow, or when to slow down. You're right. I mean, we were leaders in the unsecured space for a long period of time. But at the same time, if you look at the kind of growths that we've seen over the last 3 years, it's contrarian to how the industry has been growing, much lower than this. So obviously, uh, the architecture is comfortable with whatever growth they have been putting up to.
Yeah.
But they are seeing something which is the reason why it's slower than the industry growth. And I guess as of now, you may not see it, but when the cycle changes, I think that'll be far visible. And as I said, when we talk about pricing, yields, etc., it factors into account whether it's a corporate side, whether it's the SME, whether it's retail. You know, optically for all of you all, you may think that we are in a similar segment. But you go back and see a long-term average, definitely there is a certain strength to the franchise, which means that through the life cycle, the expected credit loss is going to be much lower than anyone else. So as of now, I think the system is extremely resilient and they've bounced back ever since post-COVID. I guess the differentiation probably could be more visible when the cycle changes. I'm not saying that I'm expecting something bad. Don't mistake me for that. But it's just that we're proud of that, and we are only talking about ourselves. I think we are focused on what the risk-adjusted profitable growth that we need to focus on. I'm not worried about what happens in the outside world, but we are very sure that it's going to be a very consistent and without any gyrations on that. So that is what gives us a good night's sleep. So we're not apologetic, and I think our pricing, our credit architecture, our risk appetite is in sync with our long-term philosophy, and that is what is going to be. That is the reason why, you know, we are what we are today.
Fair point. I want to actually bring in the other components of loan book into the picture. So unsecured, clearly you thought, and therefore you did not pursue. There are other elements such as consumer lending, mortgages, the CRB portfolio, MSME. Anywhere you see that the credit cycle is now going to change, which the investor should know about.
See, the team, both the credit and the risk teams, you know, have a very tight measurement and monitoring of the same. As we speak, we not only benchmark ourselves with internally how the trends are moving within their own risk appetite framework, they also sort of benchmark vis-a-vis what what they are seeing in the market and industry and amongst peer groups as well. Obviously, that may not be visible to you, but they do have that kind of visibility. Sure. As of now, I can tell you safely that we are way ahead in terms of you know, where we are in terms of the flow rates, early indicators, etc., are extremely healthy, much more than what the industry is looking at. I'm not seeing anything. It doesn't mean that I'm seeing anything problematic that's happening. Not that way. It's just that you know we challenge ourselves and we need to be extremely comfortable that even if there is a shock in the system, you know, are we in a situation that it's going to be resilient enough to absorb the shock? And will it be within the range that we have operated in the past, adjusted for the mortgage book that's come in?
Yeah.
The answer is yes.
Got it. Thanks. Just moving to the other topic on the group level companies, life, non-life.
Yeah.
Can you tell us about, since the merger has consummated, how has been the interactions with the board management of these companies, and should we expect some material synergies to come out of these companies?
You know, the objective, I think we have had a lot of constructive discussions with the respective teams. The management teams of the respective companies are really good. Rightfully so. I mean, they are in one of the market leaders in their respective industries, and they have created and built a fantastic franchise. whilst I know that we are patronized on open architecture and we're not apologetic about that, but the objective and the discussions that I've had or we have had along with the group companies to ensure that we grow the pie. So there will be we want to focus and you will see that from the next full year of merger, and you will see the overall pie of distributing products, investment and insurance products going up, and within that, my guess would be that the share of the group companies will be better as well. It doesn't mean that the others will not grow. The others will grow, but probably the group companies grow faster. Sure. That's a broad thought process. So effectively, they will be leveraging more on our distribution strength going forward.
And this is going to be done at an arm's length, I would imagine.
Absolutely.
Like the way it has always been. So fee income should also naturally see an uplift as you distribute more and more and garner bigger market share.
Yeah, it's got to be now. Arm's length means the margins are going to be virtually common.
Sure.
It's not that we'll have disparate margins, etc., or rather unit sale price is going to be very similar.
Yeah.
So it's just a volume growth that we're hedging on.
Got it.
Yeah. All things remaining same. For example, you had last year in March of 23, you had the change in tax rules.
Yeah.
So
Yeah.
and now it's not there.
Yeah.
But going forward, assuming there aren't any regulation changes, then you should see volume growth and hence income growth as well.
Got it. There has been some talks around listing of some of the subsidiaries, HDB, being in the news. The non-life business, Ergo, is also another one. Any thoughts around potential monetization of any of these companies over the course of next few quarters?
Let's talk to the general insurance part of it is very new, and there is another partner also there in the scheme of things. So it's not something that we have spoken about. I guess we will first want to take the company to a level which
Sure.
can enjoy the distribution franchise of the bank for a start. That's the focus. We are not talking about anything on that particular
Sure.
front. As regards HDB, obviously it's an upper tier NBFC, and it's on track and we are on track to the timelines that we have set for ourselves on that. When and what that is, I think you will see it at the right time.
Sure. All right. Sashi, we've got 2 more minutes, so I'll take the opportunity to ask maybe some more questions, rather tricky. Of course, HDFC Bank, the employees are, over a period of time, we've got a lot of ESOPs, etc.
Yeah.
Last couple of years, the stock price has been a bit volatile. I, as an analyst, think about the impact of that potentially in attrition. We saw last year attrition also was higher across the board, not to single out the bank, and also the potential ramification of that on the wage inflation.
Sure.
How should we think about that?
Good question. See, the attrition was a problem last year. Large part of the attrition was in the lower end of the spectrum, in the pyramid.
Yeah.
And obviously, we were facing something very similar to what was happening in the tech industry a couple of years ago. I guess a fair amount of interventions from our side, and we are seeing that the rates coming down. So that's some amount of solace for us, or consolation for us. Is it enough? I would not think so. There's some more work that we have to do. I guess FY25 is going to be an extremely important year where, and that's one of our priorities, is to create a good employee-first culture. And I guess with the kind of intensity at which this supervisory architecture is working towards, because it's a part of their performance assessment as well, I would think that it should have a salubrious impact on the attrition part of it as an organization, especially at the junior level. So that's part one.
Sure.
As regards your second question on the impact of the impact on the options and hence the morale, yes, it is a fact that it will happen. But if you really look at it, largely the options are given to people who have been in the mid and the upper middle and the senior management cadres, where we have seen a very people with experience of more than 10, 15, 20 years, attrition levels there have been rather healthy, I would say. I think when I look at the maturity of our mid to senior levels, I think we're reasonably proud of the kind of not just the vintage, but also the kind of passion that they exude to the organization, and that is one of the other strengths that we have. I'm sure this you would have heard it in the past several years, and even now I'm saying we have about 6 to 7 levels of depth in management thanks to these people. But they are now not only just mature, they're also savvy enough to understand the what's happening in the market.
Sure.
Okay, some of them can even teach me a thing or two of why it's happening and what's happening, and you should hear some of them saying, "Don't worry, be calm, we'll bounce back."
Sure.
So, barring a few naysayers, in any organization there'll be outliers. Barring these outliers who will be a little bit disillusioned by what's happening in the market, but largely I think I'm very proud of the kind of energy and proud of our teams which exude a lot of confidence, and they want to take this as a challenge to prove to all of y'all that what a strong franchise we are, and that it's just a foreign body which has come in, which has spoiled your day one metrics.
Yeah.
But that's what it is. But incrementally, you will see the kind of profitable shares gains that we will have going forward. So the trajectory is mid to long term, and we continue to believe, and we will, I'm sure at some point in time, even the street will start to look at it rather favorably.
That's brilliant. Almost finished an hour. Any last few words for the investors?
Well, as I said, a fair amount of feedback has come in to say that our narratives could have been better, and I take it upon myself that it's a learning for me. So with all humility, I do reckon, and we will be focused. As I said, we'll have our single-minded focus is to create a very sustainable franchise, and our focus is going to be on profitable growth. And that's the only metric that I'm going to be looking at for years to come, and especially during the period of transition. We will not disappoint you, that I can assure you that.
So EPS growth versus loan growth.
EPS growth.
All right. With that, thank you so much, Shashi, and wish you good luck and your team, of course, for the future quarters and years ahead.
Thank you.
So much once again.
Thank you very much. Thank you. Thank you.